Welcome back to Happy Half Hour. That's Toby Weber. I'm Nick Shermans. Our once a month podcast to talk current events, markets, football, an informal look at the inner workings of Pure, everything under the sun. I got some good questions for you this week. A lot going on in financial markets, Fed, interest rates, inflation, markets keep hitting all-time highs despite most people think the world's ending. Where would you like to start, Toby?
I think that's where I'd like to start. I get a lot of questions from people as we go over their performance. Performance has been great this year, but I get questions about why is the market still going up when it seems like there's a lot of storm clouds on the horizon, a lot of concerns, and I know that that's always the case, but why does the market continue to go up in spite of all this stuff?
Well, the short answer is earnings have been pretty darn good. If you look at corporate earnings and you look at the market's glide path, those two things are very highly correlated, almost not quite one-to-one, but positively correlated. And earnings have been very robust. I know we got the tariff freak out. A lot of companies were guiding lower or pulling guidance. Now that's behind us, so to speak, and corporate earnings have been very good. And either companies have absorbed the tariffs or they've passed some cost onto the consumer, but they've been able to maintain their margins and pricing power. And of course, inflation is the other side of the coin, which it seems like everything is more expensive, but a lot of that ends up flowing down to the bottom line for corporations. So as long as corporate earnings are resilient and robust, I think the market should perform decently. However, we're pretty stretched, as we've talked about, when you look at any historical measure. And I sat down with a prospect yesterday, and he was exclusively invested in QQQ and the S&P 500. And that's something I see time and time again, and this is kind of derailing, but I think investors, like when you're over allocated to something that's historically stretched and it's worked, that means you're massively under allocated to other areas. And I always say the S&P is like a tech momentum index. If you put $100 into it, you think you're buying 500 companies, and you are, but 35 to 40% is going into a handful of companies. So yeah, that's worked, but there's several smart people out there now that are saying, based on where we're currently at, the S&P should return between negative 2% and 2% a year for the next 10 years. That's not a very good setup.
So clear sailing in the near term.
I'm not saying that. I'm saying most people perceive the market as less risky when it's going up, and they perceive it as extremely risky in April 2025. It's really the opposite. Unless your time horizon is 1 week, when markets are clipping along and your Uber driver is telling you how much money they're making in AI stocks, that's when you should pause and rebalance or make sure your portfolio is aligned with your financial plan and your risk profile. When there's blood in the streets, people are panicking, that's a time to get greedy.
Do you buy the theory that some of this is debasement? That assets are going up in value because the US dollar is starting to be debased?
I don't think you can ignore that, which is why we own gold and Bitcoin. And I think since 2020, the value of the dollar relative to other currencies, and certainly priced in gold and Bitcoin, is down quite a bit. And I'm actually writing about that this week. People talk about inflation all the time, and we obsess about the monthly reports and the PPI and consumer expenditures and CPI. And it's like this elusive goose chase about where inflation actually comes from. Inflation is highly, highly correlated to government spending. When you look at money supply, the M2 money supply, inflation and the M2 money supply are going up and to the right, and it's not an accident. So we zoom out and say, okay, it's likely, if you're left, right, or center, we can all agree that government spending is probably not going to get under wraps anytime soon. What assets do we want to own in this environment? And we keep coming back to four. One is gold, one is Bitcoin, stocks, and real estate. People ask me all the time, what's going to change over the next month and quarter and year? Better question is, what's not going to change over the next 5, 10 years? And I think those four asset classes clip a lot of boxes, but it's not without a wild ride. There's certainly going to be dips and fits and starts, but that brings me to a question.
Okay.
So I was reading, most advisors have 0% exposure to gold and Bitcoin. Why do you think that is?
I think that is the case because that's always been the case. I mean, even Bitcoin's a more recent phenomenon. You could only buy the ETF over the last 18 months. And gold is kind of why do I need gold? So I think it's just a legacy position, and companies figure I don't need to get tricky with the portfolio, own the right stocks, own the right bonds, and that's good enough to charge my 1%. That's why I think that they don't own a percentage in those other categories. What do you think?
The average age of a financial advisor in 2025, I don't know this, but I would wager is over 65.
That's probably high.
Really?
The average advisor is
The average advisor age, yeah, the average advisor age has got to be between like 62 and 65.
Okay, I'll give you that. I'll give you 60 to 65.
So Bitcoin's out because they don't quite understand
Sure.
Bitcoin. It's a relatively new thing. It takes competitive thought to understand it. So I'll give them that one. Gold. I mean, it's kind of to your point. If you started a career not owning gold, it's pretty hard to adopt it at this point, and I think it's one of those things you can't teach an old dog new tricks. I don't know if I can say that, but in my experience, I found that established advisors are less open to new ideas.
Well, and it gets tricky now because now I'm going to start adding gold at an all-time high, and it's gone up 70% in the last 18 months. Once you establish that position that I'm not going to own gold, I'm not going to own Bitcoin, as it performs better, it's hard to kind of get off that dime.
It's easy for us to talk about it now because gold and Bitcoin have been on an absolute tear, and I'm kind of a Bitcoin person, you're kind of a gold person, so we're both kind of running a victory lap here, so to speak.
Sure.
I mean, we're probably not talking about this if gold was down by 50% and Bitcoin was down by 40%.
That's a fair point.
So that's both sides. Another question. What is the correlation since 2020 of gold and Bitcoin? You don't have to rattle off a precise figure. Is it positively correlated? Is it negatively correlated?
You would think it is positively correlated and reasonably significantly so, but perhaps you're going to tell me otherwise. You usually tee up these questions to make me look foolish, so what's the answer?
No, this is an actual layup. Since 2020, gold and Bitcoin are very positively correlated, which all that means is they move closely in relation to each other.
Hey, got one.
Which I blogged about this in the past, how people that love gold and hate Bitcoin actually are kind of talking out of both sides of their mouth because they're more similar than different. The correlation kind of proves that. And some say, since gold has been on a massive tear, Bitcoin's kind of flatlined, that Bitcoin should catch up, and some are saying price target of 167 to 185. Compliance, I'm not saying that's the case, don't go out and buy Bitcoin, but there is evidence over the last 5 or so years that Bitcoin and gold are highly correlated, and when one asset breaks out and the other's kind of lagging, the other does catch up.
None of what we say should be considered investment advice.
That's right.
Clear. If you could only own one, gold or Bitcoin, for the next 10 years, which asset class would you own?
This is a setup, but I would probably own Bitcoin just because we're still early in the adoption process. Gold is a known quantity. Gold's one of the biggest asset classes on planet Earth. Bitcoin is slightly behind gold, and I still think we're in the early innings of Bitcoin adoption. You know, it's funny, like Harvard back in 2018 said Bitcoin is more likely to go to $100 than 100K. Fast forward to 2025. Last week, Harvard bought 116 million of Bitcoin at 116,000 per Bitcoin. So a lot of these legacy institutions are capitulating, and they were Bitcoin haters in the early days. Now they're flipping that and they're buying Bitcoin. So we're still in the early innings of that. So to answer your question, it's Bitcoin. And I would ask you the same question, but I already know the answer. Yeah.
Question for you. Did you see the pay plan that was proposed for Elon Musk by Tesla that could make him the world's first trillionaire? And if so, any thoughts or comments or on that piece of news? Of course, it has to be approved by the shareholders of Tesla. Any thoughts on that?
Those numbers are so big, it's hard for the human mind to wrap your head around. And I don't have an opinion on that. But I will say is a lot of billionaires get flack about how much money they have. Jeff Bezos said something very astute the other day. This was like last month. He was talking at a conference or something. Someone asked him a question about should billionaires be taxed more, and he said something that got the wheels turning. He said, I'm tired of people attacking billionaires because a better way to track this would be how much value have I created for other people? And he's like, look, Amazon's a $2.4 trillion company. I'm worth $100 billion. He's like, that means I've created almost $2.4 trillion of value for other people. Okay? You can invest in Amazon. Amazon has employees that pay taxes. Amazon pays taxes. They pay property taxes in the communities in which they own homes. So it's actually understated, that $2.4 trillion number, which is massive, about the ripple effects and the economic impact. And I always say that every other country is trying to create their own Amazon. Every other country wants their own Wall Street and Silicon Valley. And what makes our country great, in my opinion, there's a list of things, but probably near the top is our workforce, our intellectual capital, our companies. That's what makes America great. It's certainly not our politics. It's not our demographics. So I just think we need to be mindful of how we operate with policy and taxes and rhetoric, because a lot of these billionaires, a lot of these companies create enormous economic value.
Okay, well said.
I've got one for you. So I track AI very closely. I've challenged the team to use AI and streamline our workflow from investment research to back office. And I watch OpenAI because they were kind of the early leader. And they came out with something very interesting. They projected their cash burn would be much, much higher than they previously thought. So they're expected to burn something like $130 billion a year by 2030. Mm-hmm. And it just makes you wonder, and they're still not profitable. And it's just, I just can't wrap my head around the equation. Our energy grid is antiquated and stressed. They're trying to build these data centers, investing hundreds of billions of dollars a year. OpenAI's cash burn, they're still not profitable. There's just a lot riding on this. And the early returns leaves one to wonder, like, is this going to pay off?
Are you inclined to think that the AI revolution, or whatever this is going to follow a similar trajectory to the internet back in the 2000s, in terms of a ton of hype, a ton of money spent on it, and then there's a bit of a shakeout, and 80% of the companies go away, and then the 20% that are left, turn into behemoths? Or do you have another thought on how this plays out?
I don't know how it plays out, but certainly that would be consistent with the journey that the internet took. Like, there was a washout in 2000 and 1999. You can certainly see that, working off the other extreme. Let's say the AI thing pays off. You think about every report that we obsess about, like the employment, the jobs numbers. The Fed has a dual mandate, inflation and employment. Every election cycle, we're talking about jobs and wages and the economy. Is it really good if the AI bet does pay off and starts taking human jobs? That breaches the social contract. You have humans that aren't working. A lot of people have their identity and worth tied up in their work, and you take that away, I can't see how that's good for anybody. So I'm just wrangling in my brain. It's like we have multiple forces working against each other, right? We want the AI theme to pay off, and it's going to take jobs. If it takes too many jobs, it breaches the social contract. So where does it land? Probably somewhere in the middle, but it's just, there's a wide range of outcomes right now.
So have you figured out how this impacts your kids as they get older, and is there anything that you would do differently with them today in terms of college, in terms of direction, based on how you see AI playing out, or it's just you're still trying to wrap your brain around it?
I think the college equation is changing. I don't think it makes economic sense to pay $80,000 a year to come out with a degree and get a job that pays $40,000 a year. And then when you think about all the information on YouTube and online, AI, certainly I think the academic equation needs to change. There's schools now that are adopting AI that are focusing more on, hey, let's use AI to customize a tailored plan for you. Let's spend 4 to 5 hours after that and work on life skills. So I think that is promising. As far as service work, I've started to talk to my kids about AI-proof jobs. So, the blue-collar trades, certainly nothing wrong with that. There's a shortage of plumbers, electricians, construction workers. I think all of these areas are worthwhile to start to look at. Unfortunately, there's a negative connotation with that type of work, which I don't believe that. But I certainly think the future of work looks different than it has over the past 30 years.
That's right. I've got one more, but you got anything else there you want to cover?
Okay, the last thing on the AI theme, Goldman Sachs tracks AI adoption for U.S. companies. And AI adoption for U.S. companies has slowed over the past month. So, to your point, there's going to be fits and starts. There could be a blow up. The capital's flowing right now. A lot of these AI companies can get fundraising from private equity, outside investors. But at some point, if that bet doesn't pay off, I think that whole equation kind of blows up. And AI adoption, AI use by end users, by consumers, by companies, by government is something that investors need to watch closely, especially if you're invested in QQQ, SPY, the S&P 500. A lot of those future returns and outcomes are going to be predicated on if the AI bet pays off.
Yeah, you have some of the biggest companies in the world spending hundreds of billions of dollars a year, real money, real cash being spent, and if they don't get a return on that investment, not only will their financials suffer, but all the depreciation that they've spent for the capital they've brought in. So you could have an equation where earnings start to suffer if they don't see some real tangible benefits from AI pretty darn quickly here in the next year or so. So that's definitely a risk out there that we continue to monitor and continue to watch. Okay, I got one for you. I get this question a fair amount from clients, and I just thought it might be a nice opportunity for you to answer it. Give an update on Pure, where we stand today, how the firm is doing, what are we working on, just kind of a state of the firm, if you would, on Pure.
Pure is doing great. We're up to, I think, 414 million. We're growing. We've been growing at 20% a year. We hired a paraplanner, a junior planner, a month and a half or so ago. We're still looking for a lead advisor. That's been fleeting, if you will. We're very picky with our culture and what we're looking for, and we've gotten in front of some great candidates, just haven't found the right fit yet. So that's a process that we're still embarking on. The asset allocation, the investment strategy, the communication, I think, not to toot our own horn, but we've called the last year pretty well. Not that we make calls, but through our weekly communications, I feel like clients have felt comfort knowing that we have two hands on the wheel. Like I always say, we don't have salespeople, we don't have sales goals, we're not out beating the bushes looking for clients. We're talking to clients, we're writing content, we're investing the money, we're running financial plans. That's all we do. So it's good, and when it's good, I always pause and think about what could go wrong. I think a successful business, you always have to have a healthy dose of paranoia. So we lead with risk management. We lead with what could go wrong. We're always testing the asset classes in which we own to see how they move in relation to each other. But back to the business, it's been really great, and one theme that we've been focused on is the AI theme. So we've challenged our associates to have whatever AI tool that they want to use open on their desktop, to use it for 30 minutes a day, and then present to the team ways in which you streamline your workflow. And we've uncovered some pretty cool, both client-facing things, back office things, investment things that we've rolled out that has freed up our time further. So, I always like the saying that your job is not going to be taken by AI. It's going to be taken by a human that knows how to use AI. So that's something that we're really focused on. And our junior planner that we hired actually built AI applications in the military. So he's really advanced our effort, and some of the stuff that he comes to our team meetings with, it's like, whoa, this is kind of over our head, but we're slowly starting to tap into his expertise and uncover some pretty cool things.
No, that's great. Even if some of that was literally tooting our own horn.
Yeah.
That's great. So.
And know that we still take a ton of business from legacy advisors. So the big Wall Street firms that you see on TV, that you see in the newspaper, that you see their chief investment strategist on Bloomberg, we take 90% of our clients come from those types of firms. And right off the bat, we can save people money because we don't need to make 50% profit margin or 40% margin. We're not a publicly traded company. So we can offer a lower fee, personalized service, stripping out the conflicts of interest and misaligned incentives. If we get in front of a person that works with one of those advisors, our conversion rate is quite high because most people like to get a higher level of attention and pay a lower fee. They like to strip out the conflicts. We're not shoving products down their throat or annuities or anything like that. So if you're working with one of those advisors, at least let us take a look and show you how we can add value.
Okay, I got one more question for
Sure,
you.
let's go.
Summer ended, sort of. Fall starting up. Any memory you want to highlight from the summer or anything you're really looking forward to in the fall? You mentioned football earlier.
Summer. So we went to Sun River twice, which was great. We spent 3 or 4 nights each time there. The kids obviously love it. They're of the age where we're out of the quote unquote suck. We're out of the diaper phase and the car seat phase. So they're their own little people. We went kayaking, bike riding, golfing, all sorts of stuff, and that's pretty fun. And now we're in school. I have kids sports 6 nights a week. I coach soccer. I'm coaching basketball right now, and if you coach, it opens the floodgates to coach other sports. So I'm actually having to push back because it's a bit of a rat race, but it's what we signed up for. It's what my parents did for me. So I'm happy to do that for my kids. What's going on with the Weber family?
I think fall is a good time of the year. More family events, more family time, if you will. So we look forward to fall every year.
Well, and it's not 100 degrees and pouring sweat, which is nice.
It's also a real benefit. So.
Well, thanks for tuning in. That's Toby. I'm Nick. This is Happy Half Hour. We wish you the best. And if there's anything that we can do, if you want us to look at your portfolio, send us a note at insight@pureportfolios.com. We'll see you next month.